Ladies and gentlemen, good day and welcome to Trustline Holdings Investor Call for PMS Fund. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Arunagiri, Founder, CEO and Chief Investment Officer. Thank you and over to you.
Thank you. Hi everyone. Good evening to all of you. Thanks for joining this call on a weekday. Really appreciate that. Just to give a backdrop, we had sent our quarterly newsletter on July 4th with the highlights on portfolio performance and portfolio actions. Most of you must have had a chance to review that. This call is to take it further from there and then provide an opportunity for all our investors to understand more about our portfolio strategy, our market view, and more importantly, how the portfolio is headed or structured for future performance. In terms of structure of the call, it's similar to what we have been doing in every call. We will begin with market commentary, then move on to portfolio highlights and actions, and then conclude it with a Q&A. That's the plan. We would like to wrap up this session in 45 minutes to 1 hour. Will not take too much time. So let me straight away jump into the first section, which is on the market view. In today's market, the hot topic on everyone's mind is the possibility on correction. No discussion on markets these days can get completed without discussing about the market correction. Most of the investors are wondering, with the kind of rally we have seen, one-way rally we have seen for the last 1+ years, how will this market correct? What can break this market? What will trigger the market correction? If there is going to be a correction, is it going to be a price-led correction or time correction, or is it going to get away with a minor wobble or consolidation? These are the questions that are running on every investor's mind. And what is more interesting is, when everyone is wanting or expecting a correction, market rarely corrects. That's unfortunately the nature of this market. And what is also more interesting is, the same issues we had discussed 6 months back in our previous call. The issues were no different. Markets were running high and we discussed the same thing. Even now, the markets are one-way rally, it's, further gain momentum. The issues remain same. But not everything is same with respect to in the last 6 months. Some things have changed. One of the key critical things which has changed in this market is the underlying technical structure of the market. Let me explain a little more in detail. Of late, we are noticing a new trend, especially in the broader small and mid-cap categories. Stock prices are driven more and more by narratives and stories and less by fundamentals. Of course, this trend was there even few months back, but it is getting more pronounced as the days go by. Probably this is a reflection of growing retail participation. I'll share 2 data points which are kind of a proxy for heightened retail interest. These 2 data points basically are about the daily transaction volumes in cash transaction volumes in stock exchanges. The other one is the F&O value for the month. So let's take the first one, which is both exchanges together, the daily cash turnover in the BSE and NSE stock exchange taken together. 6 months back, the number used to be around 60,000 to 70,000 crore. That number, as we speak now, is averaging around 1.2 trillion rupees. The number looks a little scary for the month of June, where the number went all the way to about 1.65 trillion. That's one part of it. And if you look at the F&O total value for a month, 6 months back it used to be about 314 trillion rupees. This is a very, notional value of F&O transactions. In the month of June, it was near 500 trillion. Both these numbers indicate one thing very clearly, that the retail interest and the participation in the market has grown dramatically. But as we have seen in the past cycles, whenever the retail participation moves up dramatically, the breadth of the market comes down, the market becomes shallow, and very few stocks do the heavy lifting for the indices. I'll just quote one of the analysis done by the recent ET release, where they had mentioned by their analysis what they had found out is only 20 stocks had contributed to 50% of the returns, the calendar year returns, YTD returns, for both BSE Mid-Cap 150 Index and BSE Small Cap 250 Index. Which means 8% of the stocks of BSE Small Cap 250 and 13 or 14% of the stocks of BSE Mid-Cap 150 have done the entire heavy lifting. This concentrated gains in few stocks is one of the significant reasons for many of the money managers, be it mutual funds, PMS or alternate investment funds, to underperform in the last 6 months. Needless to say that if this trend continues, probably the underperformance will persist. But the natural question, the next logical question one, if this trend continues, is it going to be risky for the stability of the markets? Of course, yes, if this heightened speculative activity of retail continues, it could scuttle the stability of the markets. That's a real risk. If you go back and look at the past corrections in the Indian, equity markets, most of the corrections, be it 2013, 8 or 2018, most of it corrections were triggered by either global reasons or by the local weak macro fundamentals. Today the situation is different. Our macro has never been stronger, be it corporate balance sheets, bank balance sheets, government finance, fiscal deficit, your current account deficits, currency outlook, forex reserves. All of it, if you look at, it's never been stronger than what it is currently. So that risk for the market is very limited. The risk coming from macro for markets is very limited. Having said that, the risk from speculative activity can lead the markets for an accident. That's a real possibility. Now, this is where I think probably, government as well as the regulator would probably intervene. That's our hope. And the last thing the government or the regulator would want when the macro fundamentals are so strong and the growth prospects are looking really robust is an accident in the market because of heightened speculative activity. What we understand is both regulator as well as the finance ministry probably has taken cognizance of this development, and we are already seeing some kind of proposals being discussed from the regulator in terms of tweaking F&O provisions, either increasing the size of the futures and options lot size or increasing the margins and other various measures which the regulator is already looking at implementing, which could probably bring down this speculative activity in the F&O segment. At the same time, I think there is a good possibility that the finance ministry in this budget might probably look at some kind of a special tax for F&O income. So if these measures come through, probably I think the risk levels in the market would come down. That will lead to more stability in the market. That's one side of the story for the market. On the other side, what we have been already witnessing in terms of local flows, domestic flows, that trend which has been there for a while, but we are seeing increased traction and more acceleration in terms of the quantum of flows which are coming from the domestic side. Look at the recent SIP numbers. They hit a record of 21K in the month of June. This is the first time when SIP gross inflows have touched 21,000 crore. And look at the mutual fund new folios in a month. It has now already hit 4 million in the month of June. Number of demat accounts have been consistently moving beyond 4 million every month. And now that the FIs are coming back post the election outcome, because in May they were selling, in June they have come back with about $3 billion net inflows, and the number of, if you look at the number for July, it's again encouraging in terms of FI numbers. So if you put these two together, it looks like that this year, FY25, the markets might see close to about $40 to $50 billion inflows, both FIs and domestic together. That's a lot of money for the markets. And unless this money gets absorbed by primary issues or QIPs or offer for sale from promoters through block and bulk deals, it may be really, risky for the secondary market if the entire money needs to get absorbed by secondary market, because it will lead to further acceleration in valuation, which is already high for the Indian markets. So here I think there is some hope. If you look at the QIP numbers recently, which was released for the financial year FY25 for the last 3 months, I think it has hit already a multiple times kind of numbers which was done last year. And the estimate is QIP alone would probably get to hit about $15 billion this year. Add to that the kind of IPO pipeline, which have now, if you look at the pipeline for IPOs, I think that number is also looking strong. Just to share an example of Hyundai is looking at 25,000 crore in terms of raising money from the local markets, and more MNCs probably would look at listing given the kind of attractive valuation what they are seeing in India. Plus, the promoter selling from MNC side, we must have witnessed in the last 2-3 months, there's increased MNC parents selling their minor stakes in Indian markets to raise money for their global challenges. So if you put all these together, I think if the supply also increases in proportion to what the money inflows which are coming into the market, then the risk to the stability of the market will be limited. In that there is hope, because there's a lot more supply is expected to come in this year for the markets. So given these kind of market settings, our approach is going to be something similar to what we have said in the last call. There's not much of a difference in terms of our overall approach to portfolio strategy. We will use this strong rally selectively to exit from weaker positions. Stock-specific pruning in high-weight allocations to raise cash levels. Stay only on quality positions even if the weights keep going up, given the strong medium-term outlook for the markets on attractive India story. Stock-specific new additions. It's not that we have stopped adding stocks. If we can find undervalued opportunities which are ignored by the market, even in this market it's available, that's a good thing. And we continue to add. Not in large numbers, but we are happy, to share that in the last 1 quarter we could identify at least 2-3 opportunities which meet our screener requirements, which meet our filters, which meet our management requirements. We are able to add such positions. So this is the overall backdrop, and in terms of markets which I want to share with you and highlight the current structure of the markets. With this, let me conclude my initial section on the market commentary. Thank you everyone. I think thanks for the wonderful participation. I enjoyed responding to all these questions, and I really look forward to the next call, which will be 6 months away. Thanks a lot. Thanks once again for your participation. Thank you.
Thank you, sir. On behalf of Trustline Holdings, we conclude this conference. Thank you for joining us, and you may now disconnect your lines.
For more videos, subscribe to our YouTube channel for our regular updates and follow us on other social medias.